Chapter 3: The Accounting Cycle for a Merchandising Business. Welcome to Chapter 3 of Principles of Financial Accounting. In this chapter, we will explore the accounting cycle as it applies to a merchandising business. While the previous chapter focused on service operations, this one introduces businesses that buy and sell goods, an essential part of commerce and trade. A merchandising business earns revenue by purchasing goods and reselling them to customers at a higher price. This difference between the cost of goods sold and the selling price is known as gross profit. Unlike service businesses, merchandising firms must track inventory and account for both the purchase and sale of goods. The accounting cycle remains largely the same as in a service business, but it includes additional steps and accounts related to inventory, cost of goods sold, and sales returns or allowances. These additions ensure that financial reports accurately reflect the profitability and financial position of the merchandising enterprise. In this chapter, we will discuss how merchandising businesses record transactions under both the perpetual and periodic inventory systems, how to adjust and close accounts, and how to prepare financial statements under the accrual basis of accounting. Section 3.1: Merchandising Operations. A merchandising business purchases products from suppliers and sells them to customers. The cost of purchasing these goods is recorded as an asset called merchandise inventory until the goods are sold. When the goods are sold, the cost is transferred to an expense account called cost of goods sold. The difference between sales revenue and cost of goods sold represents gross profit, which measures the profitability of a company's core operations before deducting operating expenses such as salaries, rent, and advertising. Two main types of inventory systems are used: the perpetual system and the periodic system. In the perpetual inventory system, inventory records are continuously updated. In the periodic inventory system, inventory is physically counted at the end of the accounting period. Both methods are acceptable, but the perpetual system offers greater accuracy and efficiency. Section 3.2: Recording merchandise transactions. When a company purchases goods for resale, it records them as merchandise inventory. The accounting treatment of these purchases and related transactions depends on whether the company uses the perpetual or periodic inventory system. Under the perpetual system, every purchase is recorded directly in merchandise inventory. Purchases on account increase merchandise inventory and accounts payable, while cash purchases increase merchandise inventory and decrease cash. Additional costs such as shipping and insurance are also added to merchandise inventory. When goods are sold, two entries are made: one to record the revenue and another to record the cost of goods sold. Under the periodic system, purchases are recorded in a temporary account called purchases. At the end of the period, cost of goods sold is calculated as beginning inventory plus net purchases minus ending inventory equals cost of goods sold. Section 3.3: Sales returns, allowances, and discounts. Sales returns occur when customers return goods. Sales allowances are price reductions for minor defects. These are recorded in contra revenue accounts called sales returns and allowances. Sales discounts encourage early payment and are recorded in another contra revenue account called sales discounts. These accounts reduce total sales and help monitor performance and customer satisfaction. Section 3.4: Adjusting entries for a merchandising business. At the end of the period, adjusting entries ensure that revenues and expenses are recognized in the correct period. Under the perpetual system, adjustments are minor and may involve correcting inventory discrepancies. Under the periodic system, cost of goods sold is determined at period end using the formula: beginning inventory plus net purchases minus ending inventory equals cost of goods sold. Section 3.5: The adjusted trial balance for a merchandising business. After adjustments, the company prepares an adjusted trial balance. It includes all account balances after adjustments: assets, liabilities, equity, revenues, expenses, and inventory-related accounts. This ensures that total debits equal total credits and that financial statements will be accurate. Section 3.6: Financial statements for a merchandising business. The income statement for a merchandising business begins with net sales, total sales minus returns, allowances, and discounts. From this, cost of goods sold is subtracted to determine gross profit. We can express this verbally as net sales minus cost of goods sold equals gross profit. After subtracting operating expenses, the result is net income. The statement of retained earnings updates retained earnings for net income and dividends, and the balance sheet presents the company's assets, liabilities, and equity, including merchandise inventory as a current asset. Section 3.7: The closing process for a merchandising business. At the end of the period, temporary accounts, revenues, expenses, and dividends are closed. Merchandising businesses also close accounts like sales discounts, sales returns and allowances, freight in, and cost of goods sold. Revenue and expense accounts are closed to income summary, which is then closed to retained earnings, followed by closing dividends to retained earnings. Section 3.8 The post-closing trial balance. After closing entries are posted, a post-closing trial balance is prepared. It lists only permanent accounts, assets, liabilities, and equity, to confirm that the ledger is balanced and ready for the next accounting period. Summary of the accounting cycle for a merchandising business. The cycle begins by analyzing transactions, recording them, posting to the ledger, preparing the trial balances, adjusting entries, and financial statements. It concludes with closing entries and the post-closing trial balance, ensuring accuracy and readiness for the next accounting cycle. End of Chapter 3 The Accounting Cycle for a Merchandising Business.